gives you a glimpse into the various tools that banks and lenders are using to extend and pretend. And I hope it also points somewhat towards the idea that the extend and pretend has actually been, it's probably been a better solution than just allowing the market to fully enforce and to just, to be so stringent that you're going to come in and the minute the borrower trips on one default provision, now go and tell that borrower, hey, you're in default and we're going to foreclose on your property. Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill by Mel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good afternoon, good morning, and good evening. Wherever you are joining me today, thank you for tuning in. My name is Bill by Mel. They call me the Debt Doctor. And Happy New Year. As we start 2026, today's episode is going to be about extend and pretend. We're going to do a deep dive and share with you all of the tools in a banker's tool shed when it comes to enforcement, loss mitigation, and the management of a debt against a piece of real estate. And we're going to talk about types of enforcement. We're going to go over a lot of stuff very briefly. And in future episodes, we'll get deeper into case studies and examples that can kind of, give you, those of you who are still learning the business, more of a true life understanding of what it means to negotiate and enforce debt that is delinquent or troubled, distressed debt on real estate. Before I go any further, I do have a kind and humble request. If you like what you see here, please click the subscribe button and share this podcast with your friends and your colleagues as we look to grow this community. It's been just 6 months since we founded the Debt Doctor podcast, and we already have thousands of subscribers on YouTube, hundreds who are listening through wherever they listen to their podcasts. And I really do appreciate the likes, the listens, the commentaries, and for all of you that are taking part in this conversation. If you'd like to see more history of podcasts about real estate, I have a real estate lowdown podcast, which I concluded last year in order to start the Debt Doctor. But there are interviews and episodes, a series called Real Tidbits, which dives into industry terms, and just some fantastic cohorts in that as well. So let's get back to the episode. If you read the headlines or you're a YouTube fanatic like myself that's just Googling commercial real estate debt or residential debt, you'd think the U.S. mortgage market is frozen in denial. There's a lot of the talk of extend and pretend in the real estate market, and when it's referred to online in social media, it's really used in a pejorative way, like bankers and asset managers are somehow maliciously hiding something from the public by using the extend and pretend methods that are available to them. But here's the truth. Extend and pretend isn't just a single decision. It's not just a kick the can down the road sort of scenario. It's really part of a very large menu of enforcement and control tools that those of you who are my bankers out there and my credit officers are using very, very meticulously and smartly as an alternative to foreclosure. And today we're going to walk through what these bankers actually can do, what they're choosing to do, and why pretending is actually the least bad option out there for a credit manager. Okay, let's talk about types of enforcement. And just to key in before we get into any of that, I do want to point out that the stress, rising stress in the mortgage and real estate markets, especially in CRE areas like office buildings, multifamily, even suburb industrial and residential investment properties. When you go to websites like CredIQ and you look at the top research articles for 2025, 8 out of the 10 top research articles of 2025 have to do with the growing amount of stress in the real estate and mortgage market. There was an article about a maturity wall that grows to $440 billion over the next 2 years. There's an article about the rise of modifications and how a certain portion of every year's maturity walls have gotten rolled into another new maturity through the use of modifications and forbearances. There's an article about cap rate trends steadily increasing. As interest rates had started to increase a few years ago, that increased buyers' expectations of what their return should be when they buy new investment real estate. That trend is continuing. Multifamily distressed volume hit a 12-year high in 2025. CLO, CRE rate, distressed rate, that's wavering. And what's going on there? The $40 billion surge in CRE loan modifications over the last year and a half. A CMBS distressed rate, which reached an all-time high since the GFC, breaking 3 consecutive reductions, now in the double digits. CMBS distress in the double digit. Office rate distress higher than 17% nationwide. And that's just 7 of the 10 articles that were the top articles in real estate. CredIQ, one of the top industry analysts. Then we talk about, is this real? Well, yes, it is. In another example of how this is real and why this is not just talk is the Federal Reserve, our own regulators who are looking at what the banks have done and are doing the last few years to prevent foreclosure. This is a staff report from October of 2024. So this is just 12, 14 months ago. And the writer of this, the article is called Extend and Pretend in the U.S. CRE Market. And the writer is a member of the staff of the Federal Bank of New York. And the article really basically shows that, I'll read the abstract to you. We show that banks extend and pretend their impaired CRE mortgages in the post-pandemic period to avoid writing off their capital, leading to credit misallocation and a buildup of financial fragility. We detect this behavior using loan-level supervisory data on maturity extensions, bank assessment of credit risk, and realized defaults for loans to property owners and REITs. Extend and pretend crowds out new credit provision, leading to a 4.8 to 5.3% drop in CRE mortgage originations since 2022. As of 2023, the Q4, this maturity wall that represents about 27% of bank capital. So the maturity wall is a real thing, and it is something to be concerned with. Okay, let's jump into the overview because I'm not going to keep you all day. We'll get into the deep dive case studies on a future episode. And again, if you like what you're hearing today, please subscribe. Please share the Debt Doctor podcast with your friends. Okay, let's spend a few minutes talking about how banks can enforce a loan. Okay, what there is a set of provisions written into a mortgage and note, the documents you sign when you take a loan against your real estate. And those provisions include restrictive covenants and certain things that you have to do as the borrower. And they are ways for a lender to control how the borrower is acting around the debt. And also they can become a tripwire if you were a bad lender and you were out to steal property from, the old loan to own. You could use some of these provisions to actually prevent a borrower from being able to reinstate. They can be some pretty precarious and some difficult provisions that when you as a borrower trip those provisions, it can be very difficult to come back from. The flip side to that, as we started this conversation, is that this is really about how many tools a bank has to work with and help borrowers to prevent foreclosure, to give borrowers the necessary time to work out whatever's not working on the property and get back to a level of stability and out of stress. And one of the interesting things that I've experienced and that I've heard from cohorts in the industry is that this is really, the banks have actually done a relatively good job of working the methods that are available to them. And if anything, history has proven in many cases that this is the right way to go to avoid foreclosing. Banks don't want to own real estate. They are not in the real estate ownership business. They've been out of it for decades now. And same with many private lenders. They are just want to clip a coupon. So the ownership and the need to enforce actually becomes a harsh reality for a lender when a borrower was not so this really does, these tools have their purpose is the point. And this is not meant to be a oh my god crap moment, the world's about to end. This is really meant to look at the ways to enforce, the options available, and they're really the tools in the tool shed that my bankers, friends, and I use to help borrowers avoid a foreclosure, to help us avoid taking back a property. Okay, so let's get into it. Hard legal enforcement. Let's start with these obvious tools, okay? There is obviously a foreclosure. You've seen, you read about that stuff in the news all the time. But let's talk about the ways that a loan can be enforced in a way that borrowers could trip up, and so that you have those tools. Okay, so let's talk about hard legal enforcement, the well-known tools. Obvious stuff, payment default. That is the number one most common way a borrower falls into distress. Is they have their monthly payment, it is due, they don't make it within that 5-day grace period, and once they become 30 days past due, they are facing the potential for default. Officially, those of us in the world of mortgage management and servicing do not consider a loan really default ready. In other words, you wouldn't send a default notice accelerating a loan, putting them into a foreclosure process until a borrower is at least 90 days past due. So it's after that first missed payment is where the phone calls start from the lender, the servicer, and it's in that 30 to 90 day window where a borrower has maybe missed one payment or has been late, that you as the lender banker want to get in touch with that borrower, servicer of the loan, and figure out what's going on. Was this a momentary blip and you'll get back on track? Is this a sign of something greater? But these are the hard legal enforcement tools. If I send as a lender, if I send a payment default notice that accelerates the loan, that starts a foreclosure process, that it may mean that I'm starting to charge default interest if it's an investor or a commercial loan. The way that I can enforce that acceleration is through a foreclosure action where my lawyers just simply either judicially or non-judicial, depending upon the state, will go out and serve that notice, give the borrowers an opportunity to respond, a certain period to pay off the loan. In non-judicial states like Texas, you might only have 90 days or another 60 days to cure the loan, work something out before I take that to a foreclosure sale administratively at the steps. In judicial states, you have the opportunity to answer it in a complaint, hire a lawyer, represent yourself. Any way you look at it, foreclosure action is really the nuclear option. It's really the option that all of the banks are trying to avoid. Banks don't have the mechanism to own and manage real estate. Not even the private equity lenders that are in the private credit market have the tools necessary to own and manage and dispose of real estate. Now, there's some of the other enforcement actions that are these hard legal actions where we're really trying to, as the lender, we've given up on the borrower, or we're trying to force the borrower to take action. And there are things such as the appointment of a receiver. In CRE real estate or residential investment real estate, we can go to a court and ask them to appoint a receiver, very common in commercial loans, where we as the lender can now control the cash flow of the property. Because a lot of times what happens if you get into a precarious situation as a borrower, or you're dealing with a borrower who is maybe less than ethical, if they decide that they are no longer going to pay their mortgage, but there is income on that property, well, they might just try to strip that and wait out the foreclosure and pocket whatever cash is available. The other reason, as the lender or the investor, you want to appoint a receiver is not only to protect that cash flow from going into the pockets of the borrower and rather to you, but also as a protection measure on the asset. A lot of what happens in the enforcement and loss mitigation process as lenders is about preserving the value of that real estate. If a borrower is going delinquent and they just decide to kick all the tenants out or allow the property to go into disrepair, then as the lender, it really becomes our responsibility, hence through the appointment of a receiver, to manage the property and prevent further losses in value through mismanagement of the property. There's also something known as UCC remedies. UCC code allows, this is again very common in the commercial loan world, where it allows us as the lender to go in and take an assignment of the rents. It allows us to go after business assets, sometimes even can take control of the entity that owns and manages the real estate. So that's also a very common tool. So now let's talk about covenant-based. This is the second category of enforcement, and it's often really underestimated. This is where you get into some of the gray area between lenders and borrowers, and where often, if you read about articles, especially in these big $100 million, $50 million commercial loans, and you hear about a loan in Miami that's in foreclosure on a half-built condo building in downtown, and you actually have the borrower countersuing the lender, and it's often because of the covenant-based enforcement actions that lenders take that borrowers will have a reason to countersue and try to defend their position, because that's where you get into more of a he said, she said. The covenants are some of the like I call it the gray area, but it's really the fine print of the mortgage and note document. Most commercial loans, investment loans have financial covenant triggers in them. And that means that certain things that have to stay true with regard to the loan, even if it's performing. So you can't just be someone who just pays the mortgage. You actually have to manage the property correctly, and the debt still needs to have certain characteristics. So such as loan to value. And this is where we get into, and I want you to start to think about this in terms of where the shifting real estate market is. Remember, we talked about increases in cap rate expectations on commercial real estate. Well, an increase in cap rate expectations really means that the value of that commercial real estate has gone down, because it's an inverse effect, right? If you are making $100,000 a year of net income on a commercial real estate property that you're using as an investment, and I'm willing to take a 5% cap on that return, then that means that that property is worth 100,000 of net income divided by 5%. So that property is now worth $2 million because I'm dividing that $100,000 of net. Now, if the cap rate expectation of the buyer increases, meaning the new buyer wants a 7% return on that same $100,000 investment, well, let me do the quick math on that. 100,000 divided by 0.07, the property value just dropped from 2 million to 1.428 million. So you can see how a rising cap rate environment is lowering the value of commercial real estate. A lot of this commercial real estate value has yet to be realized in reality in the world. And this is kind of where you get into some of the conversations that we've previously had about this confluence of rising interest rates, increased costs to maintain real estate through insurance, property taxes, and capital, and that being a force as on the declining value of real estate. So commercial real estate has just declined in value just because of the increase in cap rate expectations. Now, a lot of that's leveling off, so we're not seeing like a forever bottom, but this is how LTV can become an issue for a borrower. This is how DSCR violations could become another financial covenant trigger for borrowers, because as the price of the value of the real estate goes down, if I got a mortgage at when cap rates on real estate were 5%, on, let's say, and I got a mortgage that was very high LTV, like the highest the bank would give me, 70, 80% LTV. And now the real estate value has come down. When the bank goes to revalue that real estate, it's very likely that for no other reason than the market trend having declined and the fact that I haven't paid the mortgage down in the first couple of years of owning this real estate, that now I am in breach of my loan to value covenant. And this is something that you're going to see very commonly happening. This is a soft breach, because a bank's not going to necessarily look like, again, remember, banks are not trying to own the real estate. Bankers want to see you keep performing. They want to see themselves stay in compliance and see you as a happy customer. So there's other such covenants. Let's get into some of them. Again, I said I wasn't going to deep into any one area. DSCR violations, debt service coverage ratio. If you have, for instance, a variable rate mortgage that you took out 5 years ago, so it might have started at 4.5% or 5%. Well, as interest rates have risen over the last few years, that if you had an adjustable rate mortgage on any real estate, residential or commercial, then that rate has increased, meaning your payment has increased. DSCR is the debt service coverage ratio. If your debt service coverage ratio might be a requirement of 1.2 or 1, so that means that the lender wants to know that you're bringing in 1.2 times or 120% of the debt payment amount, debt service coverage amount, They want to see at least 120% of that coming in from tenant rents. Well, if the debt service has increased because of the interest rate increases and you're on an adjustable rate or you're coming up for a maturity refi, then your payment has gone up. Even if the income on the property has remained the same and has not declined, you could go from a legal debt service coverage ratio to underwater just by way of the increase in your payment. I use the example of a 4% mortgage that was given in 2021. If that was at a 1.2 debt service coverage ratio and rates went on that mortgage went from 3.5% to 6%, that 1.2 DSCR is now a 0.85 DSCR, meaning the cost of that debt service has increased to more than the income you were bringing in on the property if nothing else changed. There's also certain other covenants to consider: liquidity, net worth. If you're a corporation, the bank wants to see a certain amount of money in the bank. If you own a large piece of property, often gives the lender enforcement rights. All of these covenants give the lender options to enforce and trigger a default, even if the borrower is paying specially. This is not in addition to a borrower saying, hey, I can't pay. And when you take out a commercial loan, you got to do more than just pay the mortgage. Okay, so let's get into some of the other covenant-based enforcement actions. And again, we can get into case studies in future episodes about how these actually have gotten worked out, how they've been used good and bad by borrowers and lenders for the loss mitigation efforts on non-performing, subperforming loans. Let's talk about some of the stuff that, probably is less known. And I'm not going to get into too much of it, but we'll deep dive more into it in the future. There's such thing as a cash sweep activation that lenders can use. And basically, there are provisions that in certain mortgages that allow excess cash to be trapped by the lender and redirected to the lender in the event that they think a borrower is about to default or is losing control of their property, or for one reason or another, the relationship has gone sour and they want to enforce. There's something known as a springing guarantees provision. These are personal guarantees that only activate in a loan after other covenants have been failed by the borrower. So it's a way for us as a lender to say, hey, this is supposed to be a non-recourse loan, meaning you're not personally liable other than certain springing guarantees that we could enforce if you're failing at certain covenants. Well, that can overnight take a borrower who's kind of just blowing you off and waiting and trying to figure things out and not work with you. It can really, as a lender, give you the action to put a little bit more weight on the borrower needing to come to the table. There's a lot of what makes these deals fall apart, what makes foreclosure necessary, what makes loans really go bad is the lack of communication, the lack of honest and transparent communication between borrower and lender. And it goes both ways, by the way. It's not just, hey, the borrower is the one who's always hiding. It is sometimes the lender themselves, the credit officer or the banker, or in the case of private equity, a guy who may make more money by foreclosing on you than he would by just allowing you to give you a deal and allow you to refinance or modify. There's some other provisions in the mortgage and note that could spring default provisions. For instance, many loans have a provision. If you're a first lien lender like myself, you have provisions on additional debt, freezing the ability for borrowers to have rescue capital or increasing the lender's ability to have negotiation leverage if the loan goes into special servicing or loss mitigation. And of course, there is many provisions, many commercial loans have provisions for consent rights of the lender. consent on capital improvements, consent on certain leases, consent on sale of the property, consent to even refinancing provisions. A borrower can actually become operationally constrained by this stuff. And so it's ways that the lender can, enforce the loan. But it's also the reason I bring all of that into play. It's also ways that lenders can use to some of the tools to help extend and pretend. There's some other more technical administrative ways that a borrower could fall into default: insurance non-compliance, not keeping your insurance paid. Lender could have to force place, maybe not paying your property taxes, or not escrowing your property taxes. Reporting failures. There are borrowers have a requirement to report annually to some commercial lenders on the status of their financials. And then there's cross defaults. You could have a borrower where they are defaulting on a property on a loan you don't even own, but that you have some sort of cross collateralization contingency in your loan, and you find out that borrower is defaulted. Well, that gives you the option. Okay. And then there's ways that us as the lender start to use strategic moves to enforce the loan, both psychologically or physically. We send reservation of rights letters. In other words, it's kind of a notice before a notice of default, where a lender says to the borrower, hey, key actions that we're seeing that are wrong with this loan, you need to right size this, give us a call, or we may foreclose. We may institute an action of default. And then the refusal to refinance or modify is obviously is the strongest way to enforce a loan. So let's talk about the pretending. These are some of the tools that the bankers are using now. And again, this is not really just a pretend measure. There's more to it. It's not just singing from the rafters, the banks are evil. They really are trying to work with borrowers. And the ways that this are done that are most common, this was getting into the heart and meat of this episode as to what the tools are. Let's talk about some of the tools that we could use, we as lenders. Maturity extensions, that's the most common way. You can give a maturity extension on a loan without a principal paydown. Perfect example is the Willis Tower in Chicago, a loan that matured in 2021 with 4 options to extend, which it, of course, utilized. And then in 2025, the loan was given another 3-year extension. And this is I think it's like a $2 billion loan or $1.5 billion loan on what they think is a $2 billion property, maybe. It's 83% occupied, one of the top office buildings. This is not just B class, this is A class real estate with a huge debt load. The loan does fail restrictive covenants in many ways. Some of the stuff that we talked about, it's not meeting the DSCR ratio, things like that. And yet the lender has decided to give a 3-year maturity extension without requiring the borrower to bring cash to the table. And that is because that 83% occupancy is still enough to make the payments on the loan. It buys time for rates to come down, for NOI to increase, perhaps cap rates normalize in some way or alter. It's a good way to avoid putting a borrower in default. There are tons of high-end properties that are facing this kind of thing, where we've seen billion-dollar loans get extended through maturity extensions, modifications that do not require the borrower to bring principal to the table. Another good example is the Fontainebleau Casino in Las Vegas has a $1.2 billion loan on it. And, while they're obviously making the payments on that loan, but one has to wonder if and when the chickens are coming home to roost. Another way to extend and manage, so to speak, as opposed to extend and pretend, is interest-only periods. So if you have a residential 30-year amortizing loan, which includes principal and interest, you could decrease the amount of the payment the borrower needs to make by giving them an interest-only period. There's also something called payment in kind interest. So PIK, by the way, this gets into a controversial area because I have friends of mine who are saying that private equity is using this to their detriment to the level of where it's almost fraudulent. But PIK means that we as the lender says, okay, I'm taking the payment in interest, payment in kind, meaning I'm not actually getting cash, but I'm taking it as an additional note, so to speak, or that I'm registering as payment having been received, but when it actually hasn't come. Of course, there's rate resets, there's temporary buy downs, there's, you can ask a borrower to preserve the loan to value, to preserve DSCR by bringing cash to the table. The banker's favorite ways to control real estate is control where they control it without owning it is through things like cash management and lockbox structures. So if your borrower is having trouble and you can make a deal as the banker to offer to take on a receiver, appoint a receiver, or have them give us access, we DACA access to the bank accounts that the LLC manages that property with. So it creates a incentive for the borrower to do the right thing by being under having the cash kind of controlled or supervised by the lender. There's milestone based modifications. You can go to a borrower and say, hey, listen, we can step down tied to an increase in leasing. You could have provisions where as they increase, if there's tenants missing, where you could, as long as the borrower gets a X amount of lease up by X amount of time, and it really does create some incentives and ways for borrowers and lenders to work with. And then, of course, there's third-party asset management oversight. A lender approved property manager or advisor, kind of a soft receivership method. This is something that we are commonly using with our bankers or investors who are not getting anywhere with through their servicer, not getting anywhere in direct relationship, direct conversations with the borrower. Maybe something's gone wrong. The lender says, okay, I'm about to enforce the loan, or why not try hiring first lien resolutions? They're a third party. They're going to act as an intermediary to keep an eye on things and see if they can work with you and save the property. There's capital stack creativity. You ways to avoid foreclosure, and you're hearing a lot. This is a lot of what's happened in the last 2 years with the billions of dollars of private equity, private credit, private debt sitting on the sidelines waiting to take out deals. You've had pref equity injections. So a new lender comes in maybe to buy down the loan, but then their equity takes senior position to the original equity of the borrower and owner of the property. And that's often a lender introduced situation. And most borrowers are trying to hold on to that equity position. So giving up pref equity, is not an ideal situation. It allows new money to come in and take a first position to all of the years and capital that you've put in. But sometimes it's a real bailout and ability to avoid foreclosure. There's also such things as AB note structures. If the DSCR is getting too tight or the loan to value is getting tight on a loan, the borrower can pay based on 80% of what the loan amount is. You could break the loan into an A and B note, where the B note sits now in a second lien position. Maybe you call that, you put a 0% interest rate on it, or you defer the payment, forbear that note for a period of time, allowing the borrower to pay that's now a new sustainable payment, and then make the B note contingent on performance or a deferral of some sort. And then there's also the earnout shared appreciation features. Sometimes if a loan is severely underwater, if a lender is I might be willing to set aside that B note or forgive a portion of the debt in return for a share of upside in the event that the borrower is able to get out of the property and to liquidate. Maybe there's a profit incentive structure. You'll see this a lot in private credit where, we buy loans that are upside down. Borrower still wants to work with us, maybe knows the most about this property. Again, it's not necessarily in our best interest to own, a retail strip center in Wichita, Kansas. So if I can use that local expert to come in and continue to manage this property on my behalf, and I say, listen, you owe me $100,000 on this property that's only worth 90, you say now. I'm going to give you an $80,000 payoff on an A note, and anything above, if we end up selling it for 120, we'll share the upside. It incentivizes the borrower to help us get the maximized number. There's non-foreclosure exits. Sometimes these involve the borrower, sometimes they're exclusionary of the borrower. In the case of note sales, for instance, if I'm a lender and maybe I'm not the guy that wants to own the real estate, and the borrower is going into default, or they're missing on certain covenant provisions, but I don't want to necessarily foreclose that borrower. I certainly don't want to own the real estate. I might find an investor in the private market who does want to own that real estate, and I can sell that note at par, maybe par plus, maybe even a small discount, but I can get made whole and leave it to a new investor to deal with it. That could also be friendly note sales to third parties where the borrower is almost like a short sale agreement. Let's say, borrowers, as a lender, you can approve a short sale. Borrowers could avoid a foreclosure on their record by finding a buyer willing to take the property at a number that the lender is willing to approve. Deed in lieu with side agreements, taking back the property, management contracts, consulting fees, maybe keeping the borrower on as a manager of the property. But there's a lot of side agreements that go along with deed in lieu in commercial properties that could be beneficial to both parties. And then, of course, time-bound standstill agreements. That's like, the official recognition in writing of the pretend period and a structure. Now, me as the lender, I don't usually agree to standstill agreements ever, because once a borrower is in foreclosure or facing foreclosure, then I want the optionality as the lender. So that kind of runs through all of the various ways that a loan can go into default, and kind of gives you a glimpse into the various tools that banks and lenders are using to extend and pretend. And I hope it also points somewhat towards the idea that the extend and pretend has actually been, it's probably been a better solution than just allowing the market to fully enforce and to just, to be so stringent that you're going to come in and the minute the borrower trips on one default provision, now go and tell that borrower, hey, you're in default and we're going to foreclose on your property. It's a different way of lenders managing and servicing loans. And it really speaks to the way that this era that we've been in since the GFC, where it's at all costs, let's avoid foreclosure. Let's avoid, especially the last 10 years, let's use financial tools. Let's kick the can down the road, and let's find ways to allow things to not get enforced. Because once a property goes into foreclosure and you start to see a huge rise in foreclosure, we're a lemming world that we live in, right? So the market can overreact if we see a sharp increase in foreclosures. And a lot of what the feds, the regulators, and the bankers and private lenders have done by using all of these tools that are in their tool shed in terms of both enforceability, and then using those tools as ways to negotiate and work with borrowers to extend and give them more time. It's really a way to avoid a next financial crisis. And it makes sense, given the pain of 2008 and the 4 or 5 years of workout that followed that, it would make sense that the U.S. banking regulators and the banks would be looking for ways to avoid that kind of conundrum again. This is our episode on how banks can enforce a loan, what covenants exist, and how the extend and pretend is actually helping to avoid a more calamitous real estate market. If you like what you hear today, don't forget to subscribe. Thank you for joining us. My name is Bill by Mel. I'm the Debt Doctor. We'll see you next time. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.